I think you can take a snapshot in time, maybe a 1 or 2 year period, looking at some standard moving average levels and see if the stock actually reflects that it relies on those. You know, if you find
Welcome back, traders and investors. We have Adam Sarhan on the line. He is founder and CEO of Sarhan Capital. He has 3 primary services. Will you discuss those for us, please?
Sure. Morning. Well, thanks for having me back. We offer advisory services to institutions. So we have medium and small size asset managers that are looking for good ideas in the market. They come to us. We give them good ideas that make them money. If we don't, they're free to cancel anytime. That's via analyzewallstreet.com. We offer research for individuals via findleadingstocks.com. It's the same premise there. The whole goal is to make you money. If we don't, you're free to cancel anytime. There's no contracts. And then we offer asset management for people that want us to actually manage their assets for them.
Okay, so let's talk a little bit about the market yesterday. And, the Ebola news it hit in the morning, and they kind of hit the airline stocks, and the market was kind of digesting it. But when the true liquidity came in at 9:30, boy, it was lights out. Were you prepared for that, or how were you positioned?
Yeah, no, we were definitely prepared for it. We had a note to our clients across the board on September 15th, which was about 2 weeks ago, saying the day that something had changed. And if you look back on the chart, you can see on the 15th of September, it was a Monday, and we came back, and then what happened was a slew of leaders across the board, basically the generals of the market, if you will, from Netflix to Tesla to Apple, the list goes on and on and on. And we're hyper-focused on those leading stocks. I mean, the website's findleadingstocks.com. So one of the things that we look at is how are leading stocks performing, because it's a great tell for the market, both in the upside and the downside. So that September 15th, the leaders got smacked on heavy volume, and you saw a tremendous amount of selling just show up almost out of nowhere in a lot of these leaders that we follow. What happened subsequently on Tuesday, the 16th, and for the rest of that week, the major averages and some of those leaders bounced right back. Now, they never really recovered the leaders. The market, the major averages kind of did, but the leaders were still in trouble. And then what happened was you saw another leg down at the end of September, which was leading up to the month end and quarter end. So when you step back, we just put out a note earlier this week in an intra-week update saying let's analyze the month and the quarter. And every time the market, over the last really 5.5 years since the bull market began, whenever you've had QE, in other words, quantitative easing from the Fed, you've seen a tremendous, unprecedented, almost just straight-up rally in the stock market. Now, when QE ends, every time that QE1 ended, QE2 ended, we saw the S&P drop 17% when QE1 ended, and then 22% when QE2 ended. So clearly, that's been a primary driver of this entire 5.5-year bull market. Now QE3 is set to end this month. So the biggest problem for the market, or the question that nobody's answering from where we sit, is what's going to happen when QE3 ends. Will it be a graceful exit from the Fed, or will it be something that, what we saw with QE1 and 2, a big sell-off?
So you're just using the historical perspective of what happened after QE1 and QE2. And, so you're saying that, there's room for considerable downside, even though they might not take up interest rates, right? It's just the fact that the stimulus is not going to be there.
Well, exactly. I mean, look, let's just look at the facts, because that's what I make all my analysis on, based on what actually is happening, not what someone thinks is going to happen, but what's actually happening. So when you analyze the facts, let's look at the economy. In the U.S., supposedly the stronger, out of all the developed world, it's one of the strongest economies out there. Okay. So forget the fact that China's slowing down considerably, Europe's, anemic growth, if not just straight-out recession. Parts of Europe are actually in a recession, and there's just a lack of a big impetus of strong driver in the global economy. So the U.S. supposedly now is one of the strongest economies out there, and everyone's betting, oh yeah, the economy's going up, up, up. Okay, great. This year, we've had lackluster economic activity, growth, whatever word you want to use, with the Fed printing billions of dollars every single day to stimulate both Main Street and Wall Street. So in 2014, while QE has occurring, we saw Q1 GDP down 2%. We've seen manufacturing slow considerably. We've seen housing just dismal. No, I mean, this is month after month after month. It's not just a one-off. So we haven't seen any massive just drivers or growth that indicate to me that the economy is going to be able to grow considerably without massive stimulus from the Fed and other central banks. And until we see that, that's the critical part that other investors are aware of as well. And they're like, okay, something's missing, something's awry. I wouldn't be surprised to see the Fed show up again in 6 to 12 months or even 8 months and say, forget raising rates, let's do QE4.
Okay, Rob Hood's just popping in here, and he said, did QE2 end prior to 2011 decline of 19.4%? That's what you stated, correct?
No, I said that QE1 ended, the S&P fell 17%, and then QE2 ended, the S&P fell 21.5%, almost 22%.
Okay, all right. So how should, what are you saying to your clients that have been in the market for a long time and sitting on a lot of profits here, even if the SPOOs go down to 1900? How are you advising your clients to play this? Is it time to raise a lot of cash?
Yeah, first of all, for me, cash is a position, so there's nothing wrong with being in cash. That's critical to understand from my point of view. The second thing is I have absolutely no problem whatsoever being short. I'm indifferent. If I'm long or short, I think markets are just markets. Factually, they go up and they go down. So not to participate on the downside to me is just silly. So I have, the strategy that we use is both long and short.
Mm-hmm.
That being said, what I wait for, first of all, is I want to align the different time frames. So if you're daily time, immediate term, on a weekly or even longer term on a monthly chart, you always want to ask yourself, what trend am I trading? So right now, on all three time frames, we've been in a very strong uptrend. In the short term, you're starting to see that uptrend move sideways in the major averages. So the Russell is the weakest of the major averages or the popular indices out there. And as of right now, it's literally testing to the penny the low of the year. And the Russell, if you pull up a chart, you could see over the last 8 months of this year, since February, you're forming a large flat base or a large topping pattern. Now, if that 1082 level in the Russell is broken, which has been the low almost to the penny twice this year and then again yesterday, and again, it wasn't a mistake, yesterday's low was 83 when the prior low from the that March and May sell-off was 1082, and then the low back in February was 1082.72. So this is the third time that 1082 level or 1083 has been tested. If it bounces from here, it would be a complete logical and normal bounce. If that 1082 level is broken, then by definition, structurally, something has changed. Not only is the Russell negative for the year, but it's also woefully underperforming the broader averages, the S&P, NASDAQ, and Dow. But also, small caps tend to be another leading indicator, where if you look at March of 2009 all the way up until 14, the strongest performing on a percent basis popular index out there was the Russell for a long time. It, easily beat the S&P, Dow, and NASDAQ from a percent gain basis from the March 09 low. So the fact that the small caps are topping out or in the process of building a large topping pattern, I wait to see, for confirmation. I know what's happening right now. The short term is moving sideways in all the averages. Now the question becomes if support is broken, not just in the Russell, but then you look at the other averages as well, and of course leading stocks also extremely important to the equation, then you start saying, okay, the intermediate term has changed, and therefore we should look for a more sustained downtrend trend.
Okay.
And that's how we play it.
So let's talk about some of your short strategies. You say you play long and short. Do you try and use the futures market as a hedge? Do you buy puts? Do you sell calls? What is your preferred short strategy?
All of the above is the short answer, because we run a boutique investment advisory firm, so we have clients ranging from individuals all the way up to large institutions. One of the divisions in our company is a CTA. It's a global macro CTA, which trades managed accounts for both individuals and institutions, and uses futures. So we can go long and short futures, and that's not just equities. We use bonds, currencies, and commodities as well, hence the global macro strategy. And then with individual stocks, we could short the stock outright, or we can buy puts. Either way, the whole idea is, what is your view? Once you can understand what your view is, or do you think that this is going to happen up or down, then you find the best way to express that view based on your situation. And that's how we advise our clients.
Okay, so let's move over to the oil market and talk a little bit about the commodities. And holy smokes, oil volatile and getting smoked. Why don't you talk about the crude oil futures markets?
Sure. I mean, full disclosure, we're short crude as of right now for our accounts, so that just put that out there. As far as what's happening, the underlying structure, not just in crude, but the entire energy complex has shifted considerably over the last maybe 6 to 8 weeks. What's happened is we saw a big run up in the beginning of the summer for the Ukraine and Israel, the geopolitical tensions, which are normal because the idea is that they possibly, if they escalated, were going to disrupt supplies. Thankfully, none of those situations really escalated. Cooler heads prevailed for now, and that could change. So crude ran up to 107, and then it just started selling off when basically the market said, you know what, we're not going to war, Putin's not going to turn into Hitler, all that fun stuff, and then the market just started selling off. Concurrently, the bigger story with all of commodities is the U.S. dollar. And the U.S. dollar is tremendously important because every single week for the last 12 weeks, the dollar's been up. And since these commodities are priced in dollars, typically, not always, but typically, there's an inverse relationship between the U.S. dollar and commodity prices. So what we've seen is just a 12-week, which is unheard of in currency markets, straight rally for the U.S. dollar. And that's at the same time, you've seen a lot of these crosses, the other currencies just go straight down. The euro's imploded virtually, and you've seen a lot of pressure in the Aussie and the yen and all that fun stuff. So with even the CAD, the Canadian dollar. So a lot of these commodities-centric current areas like Canada or Australia, their currencies have gotten whacked as well. So the U.S. dollar's been one driver there. Demand is slowing. If you look at the component of any price, it's supply versus demand. So when you have demand, which is basically Main Street, not just for U.S., but the global economy, it's not robust, it's slowing. That means commodity in general, commodity prices are going to come down a little bit because the demand component of the supply versus demand relationship is weakening. So that's been another factor sending commodities lower. And then also, if you step back and you look at the entire commodity complex, we're seeing, let's just talk a longer term here. Back in the early 2000s, you saw a super cycle in commodities, which means basically picking any commodity you want and just shot straight up for years, almost a decade. And then we saw the '08 financial crisis, and all these commodities just got hit and hit hard. That was a huge bear market. It broke the super cycles back, if you will. Then the reflation trade, all this easy money from central banks, the commodities popped right back up, but didn't hit their their '07 highs or '08 highs. They were just basically had a little bit of a bounce back from being oversold. And then for the last 4 years, on average, they've just gone straight sideways. Now, you've seen some markets really move higher, move lower. Gold, for example, hit a high in 2011, an all-time high, and same with silver. But really, since then, since 10 or 11, a lot of these commodity markets have gone straight sideways to consolidate that last 12-year run, or have gone down. And now we're seeing in gold, for example, a bear market. Gold is in a bear market. Silver is in a bear market. No one's talking about it, but it is. And that's just simply defined by a decline of 20% or more from a recent high. So if you take all-time high in gold and silver since 2011, we're down, I think 25 or 30% from those highs, and silver just broke down again just a week and a half ago. So the agriculture, look at ticker symbol corn, or DBA, which is a good ETF that tracks the ags, are in a vicious bear market. So it's really important to understand that same component, the time frame, when we talked about with the stock market, with these other markets as well. What's the daily trend? What's the weekly trend? What's the monthly or annual trend? And then once you find out what type of market you're in, then you can trade along the broader trend.
Just real quickly to our traders out there, we have just hit yesterday's low in the S&P 500, 1933.75. That was a low from yesterday. That's a big number for the SPOOs to hold here. After that, looking at 29 and a quarter, which was our low on 815, but just matched yesterday's low. Adam, what about the gold market? The market's getting killed. Gold's supposed to go up. What's going on with that? There's no kind of hedge. Dennis and I were discussing that, when the market rallies, when the market tanks, gold goes up a little bit. When the market rallies, they kill it. I thought this was supposed to be some source, some sort of hedge. Can this thing ever catch a bid?
Yeah, it depends. I mean, the short answer, gold's in a bear market. Therefore, the path of least resistance is lower. That's the short answer. The long answer is that gold typically has been a strong hedge against inflation. Well, if you look around the world, inflation isn't a concern. If anything, deflation is a concern. So that inflation hedge is just out the window. And then if you look at the U.S. dollar play that we spoke about earlier, that's tremendous pressure there as well. And then if you just look at the fact that, okay, where the trading, where are positions going in the metals market, the complex itself? The answer is unequivocally the trend is down across the board in both gold and silver, and that's an important area for you to watch. But really, for gold traders, I take a look at 1179. That was last year's low. We built a long, flat base for the last maybe 16 months or so, 18 months. And if that 1179 area is broken, I'd have to expect another leg lower to commence.
Okay, are you ready for the $64,000 question?
Shoot.
Where are you covering your shorts on this move? And I know you look at things on a daily you have different time frames, but if you've implemented some short hedges here, are you banking on this 1933.75? As of right now, it's a double bottom. We just matched that. Do you have any sort of targets on the downside, or are you more the kind of trader investor that says, hey, I got room in this trade. Instead of trying to pick the bottom, I'm going to move my stops down and let the market take me up on some upward momentum?
Are you talking about the stock market short, or are you talking about other markets?
The stock market, yeah.
The stock. Okay, just want to make sure we're on the same
Sure,
page.
go ahead.
Yeah, so with the stock market, just to be clear, I still have some long positions. I'm long Facebook and Apple and a few other leaders. But for the most part, the actual positioning is I use the ladder approach. So I don't pick targets in the market and say, okay, here's my target. Because what I've learned of studying every single cycle for the last not just 100 years, but I've gone back to the 3rd century, and it's all available on fine leading stocks if you want to look back at boom and busts. And what I've learned is that markets can move a lot further than anyone thinks. So picking targets is just like picking, the sky out, the pie out of the sky type numbers. Nobody knows what's going to happen. You could say, here's my target, the target's hit, and then set a new target. But instead of doing that, because that's just a fool's game in my opinion, what I do is say, okay, remain as objective as possible, focus on the now. I know what's happening right now. I don't know what's happening tomorrow or next week or next month. No one does. If anyone does, they're just lying or they're delusional. But I know what's happening right now. So I move the stops down and say, okay, here are some important technical levels on a psychological basis. We spoke about this before, that psychological analysis for trading markets. You've heard of fundamental and technical analysis. I've coined the term psychological analysis. And really the goal there is say, okay, let me understand the investor sentiment behind these trades. So when you lower your stops, the market forces your hand, both in and out. And that's been the best way for us to remove emotions from the decision-making process and let the market guide us.
Okay, we've had Adam Sarhan, founder and CEO of Sarhan Capital, on the line. He runs a boutique investment and advisory firm. You should check out his site. Giving us some sound advice here on the markets, Adam. We really appreciate you coming on. We'd like to have you on again real soon.
My pleasure. Thank you.